we're going to calculate the stock price for Home Depot. So let's start with the market cap, 265.4 billion. And next we need a stock price, 246.97. And now we're able to figure out the shares outstanding. You just take the market cap divided by the stock price. That gives you the shares outstanding. And the reason we need that is because we're going to calculate the future free cash flows of the company and discount that number back to today's dollars. And when we do that, we have to divide it by the number of shares to get a calculated share price. So we know whether the stock is a buy or a sell. Let's look at free cash flow. And if we go to the financials in Yahoo, then go to cash flow, we see free cash flows for 4 years. Nice, healthy free cash flows, $10+ billion some years. That's what you'd like to see. And now net income we need, which is on the income statement, and that's the profit and loss. And we also need revenue, also on income statement. Now, we need to look at the capital structure of Home Depot to figure out the discount rate we need to apply to the future cash flows. So the interest expense is the interest they pay on their debt. That's 1.2 billion. Let's see how much debt Home Depot has. We'll go to the balance sheet and go to liabilities, current liabilities. Current debt is 2.8 billion, and that's debt due within 12 months. Non-current debt, long-term debt, 29 billion, that's debt due after 12 months. So they pay 3.8% interest on their debt, but interest payments are tax deductible. So let's get the effective tax rate so we know how much to deduct. The income before tax is 14 billion, and the income tax is 3 billion. So their effective tax rate is 24%. So the cost of debt is 2.91% because you get that deduction. So the weight of the debt is 11%, which isn't too bad. You want to have a low debt number. Now we need to figure out the cost of equity. So let's find the beta. 1.03, really good beta. Beta is volatility. That means it moves with the market. So the cost of equity is 10.23% and the cost of debt is 2.91%. Now, equity has a higher return than debt because equity is riskier. In the event of a default, debt holders are paid before equity holders. So equity holders take on more risk and therefore get a higher return. And when there is a bankruptcy, equity holders tend to get nothing. So that's why their return is either dividends or the appreciation of the stock, which tends to have the most returns. Now we figured out the weighted average cost of capital, the WACC, of 9.45%, which is a blend of equity and debt. And this is the percentage we need to discount the future cash flows by. Now let's see what the future cash flows are. We did 4 years of future free cash flow. Then we did a terminal value, which is all the years beyond year 4. And we used a Gordon growth model for that. We discounted those numbers back to today. And the value of the company is $209 billion. And when you divide that by a billion shares, we get a stock price of $194. Even though it's trading at $247, so this is considered a sell. It's trading at a 27% discount premium. Now let's look at historical. The stock price was trading below intrinsic value in March and maybe last year, but it's trading at a premium now. So stocks can trade higher or lower than intrinsic value. The stock price moves based on the market demand. If people think the business will do really well the next few years, more people will want to buy the stock and the price gets bid up. And if more people feel the stock is going to be struggling next year. Home Depots will have poor sales, or they feel there's more competition. Whatever the reason may be, if more people are looking to sell the stock, the price gets pushed down. So, as you know, it doesn't really matter what something is worth. It matters what someone's willing to pay for it. And that's the same thing with stocks. So everyone has their own opinion on the value of a stock. This is my model and my opinion. Thanks for watching.